So as Reed was saying, unless you've been under a rock, you've probably heard a lot of news about OPEC over the past couple of years. So we're going to talk a little bit about OPEC and a market update in general. And then we're going to talk about a few terms that you hear in the news that are affected by prices and that might affect prices as well. Things like rig count and storage for both crude oil and natural gas. So I think we all know who OPEC is. I was interested to see the full list of the countries, and notable absences are obviously Russia and China as number 3 and number 4 producers. And lately that's been interesting in the news because on Monday, Russia and Saudi Arabia met and had made an oil cooperation agreement, which doesn't necessarily mean much because it wasn't an agreement to freeze production just yet, but I guess to work on it. Sentiment is kind of up and down on that. We've heard from a research firm, Wood Mackenzie, earlier in the week that they think there actually will be a production freeze because a lot of the countries are close to their maximum production levels, and we'll get a little more into the details of that. It remains to be seen. If you look at the Wall Street Journal today, there's an article saying, sentiment doesn't have confidence in a production freeze coming up. So you'll also notice some of these countries, Venezuela and Nigeria are, for example, and some of the other countries are really affected economically and experiencing some civil unrest due to the low prices. So it might be great for you and me to have low gasoline prices to put in our cars, but both at home where we're seeing bankruptcies, and we'll get into some of those details as well, that affect especially Texas and Oklahoma, and abroad where some of these countries are experiencing unrest. It causes the economies both globally and locally to suffer a little bit. So what happened in November of 2014? So we had seen demand in both China and India start to slow in 2014. And Saudi Arabia, as Reed mentioned, looked at it and said, we don't want OPEC to be the swing producer anymore. We don't want to take this pain when the U.S. is the top producer now of crude oil. We want to share in that pain and cause an adjustment there. So WTI, our primary West Texas Intermediate, our primary measurement. You'll also hear Brent crude quoted as well, but we focus on WTI as the primary measurement. Fell below $70 immediately, and then we bottomed out at 26. Hopefully that's the bottom, we'll see, in February of this year. So interestingly, when we kind of circle back to the production freeze, OPEC is meeting in Algiers later in this month. It's September 26th, so if you want to keep an eye out for the news in an informal meeting. But as that firm, Wood Mackenzie, told us, the production freeze may be likely. And to us, again, not East West Bank's opinion, but my personal opinion, a production freeze may be likely. The Saudis are producing at 10.2 million barrels, and they've said they can produce at 12.5 million barrels. But that's, if you look at trends over the years, they've never gone above the 10.2 million barrels. So you kind of wonder if that's likely. We don't have a lot of visibility into their actual production. And you would also ask yourself why, if they're trying to kind of shift the pressure to the U.S. to be the swing producer, why would they not be producing at that full amount? Another interesting metric to note is that over the past decade, they've tripled their drilling rigs in Saudi Arabia. So why aren't they producing at a higher level? And some of the data says that their fields are older, so they have to triple the rigs to get that production out. Another interesting metric to note for Iran, as Reed said, they're at 3.8 million barrels a day of production. So they only have an additional 200,000 to go to meet their capacity of 4 million barrels. So that's not a huge jump. So like I said, the production freeze could be likely because they don't have a lot to lose. We also don't think if that happens that it's going to prop up prices much beyond where they are, maybe a few days for sentiment. So another interesting thing, just to kind of recall, I'm sure you've all seen that Aramco has mentioned that they're going to take part of the company public, and that would be a estimated $2 trillion IPO. So that would be huge, and it also would provide some data on Aramco that we don't currently have access to. So flipping over to, let's talk about domestic bankruptcies. This data is from Haynes and Boone. So if you go Google Haynes and Boone Bankruptcy Monitor, there's a lot of interesting data out there, and they update it monthly for new bankruptcies that happen. So that's interesting data to have and check out. This is just exploration and production upstream companies. So 90 of these bankruptcies have happened since the beginning of 2015, and for oilfield services, it's been 83 bankruptcies. Interestingly, also Deloitte says about a third of the oil and gas companies have a risk of being insolvent. So if you're looking at bankruptcies that have happened lately, we've had some interesting paradigm shifts from cycles of the past. For example, a lot of these companies are going to court with already restructuring agreements in place. So that's made the process a little more efficient. Also, most bankruptcies now have been filed in Texas instead of New York and Delaware. I think the thought is that Texas judges are more familiar with energy and the process can be a little more efficient. So interesting fact to note there. So Reed I won't steal his thunder for later, but as far as how we lend, it's been a shift there as well. So for example, a lot of our customers, well, luckily we have good loans right now, but a lot of my former customers, if they're about to file, they'll draw down their whole revolving credit facility to be in a good negotiation position for themselves going into that bankruptcy. Well, we begin to add covenants to their credit agreements to prevent this. So they're pretty complicated because the company needs liquidity in order to operate, but there are limitations on how much cash they can just draw to hold on their balance sheet to prevent that kind of action. Additionally, we've required increased collateral, and obviously loans have gotten a little more expensive, but that's already ticking down because sentiment's a little better about the stability of the market. And as you may have heard as well, the regulators have been kind of breathing down our neck. So they've tightened regulations on how you look at debt. So we used to be able to bring in junior debt tranches and not have to look at that as punitively. So we could kind of say, well, they're after us in the debt stack, and no longer is that the case when we look at rating credits. So that's been a real struggle for banks right now.